What are adjusting entries? Well, adjusting entries occur at the end of the financial period and is the process of making adjustments to the general journal in order to record revenues that have been earned and expenses that have been incurred during the financial period. The general meaning of debit and credit in terms of a T account is that debit means left and credit means right. The rules of debit and credit guide the process of adjusting entries. Assets and expenses have a normal debit balance, therefore are increased with a debit and decreased with a credit, whereas liabilities, revenue, and shareholders' equity have a normal credit balance, therefore are increased with a credit and decreased with a debit. When do we have to make adjustments to the journal entries? Well, when we have either a deferred revenue, accrued revenue, deferred expense, or an accrued expense, with their differentiating factor being when they record revenue and expenses. Deferred revenue is when a company receives cash before it provides the good or service. For example, suppose Netflix receives a payment of $120 on August 1st from a customer for a 12-month subscription to its services. At this date, cash is debited for $120 and unearned revenue is credited for $120. Now let's say Netflix prepares its financial statements at November 30. The adjusting entry would debit unearned revenue for the amount of $40 and credit service revenue for $40, as Netflix has provided the service for 4 months and therefore earned $40 worth of service revenue, which can now be recorded. Accrued revenue is when a company earns revenue before it receives cash. Deferred expense is when a company pays for a resource before it is used or consumed. Lastly, accrued expense is when a company incurs expenses and pays for them later. You may have noticed that adjusting entries always involves an asset or liability account and a revenue or expense account, whereas they never involve adjusting cash accounts, as the cash is either recorded at the original transaction or at a later date. The adjusting entries process must occur before financial statements are prepared, to show the exact revenues and expenses incurred in the period, to ensure they are up to date. This is an important process as it depicts the true image of a business for a period, providing stakeholders with useful information which forms the basis of strategic decision-making.